Hello and welcome to On the Money, a weekly look how to get the best out of your savings and investments. In this episode, we're going to be looking at the outlook for investing in the Asia Pacific region, and in particular, we're going to be focusing on the prospects for China. Joining me to discuss this topic is Doug Ledingham, Fund Manager of Pacific Assets and Investment Trust. So Pacific Assets has had a long-standing underweight position to China. The investment trust is still underweight versus the index, but it has been increasing exposure to China over the past year or so. Doug, could you explain why you've turned a bit more positive and where you're finding the opportunities?
So for us, Pacific Assets should always be a reflection of where we're seeing the best opportunities to protect and grow our clients' trust over the long term. Now, if you look back actually to the trust in 2010, 2011, when Stewart Investors took over, so China and Hong Kong was roughly 20% of the portfolio versus India, which I think was 10%. So over the last 10, 15 years, there's been material evolution in the portfolio, and hopefully, that's a reflection of us evolving the trust to where we see the opportunities. Now, in 2015, we were given the opportunity to invest in mainland companies for the first time through the Hong Kong Stock Connect. But for those of us that know Stewart Investors, that we take our time. For us, we're really looking to hand the Pacific Assets Trust capital to reputable, privately owned enterprises with great stewards, very attractive business models and long-term opportunity for growth. When we first started looking at China, a lot of the companies that we were interested in just hadn't been listed for very long. We really are looking at financial history to get an insight into the behavior of a franchise, the behavior of the people that we're handing the trust's precious capital to. And so for us, time was important in the market in terms of understanding the opportunity set, and also valuations. I think you could probably spend a whole podcast talking about valuations in China and what that really tells you. But for us, the types of companies that we're interested in, you remove the big state-owned banks, the state-owned insurance companies, and the types of companies that we were interested in handing our clients' capital to, we're not that cheap, and we're actually probably more expensive for the growth opportunity versus where we're being asked elsewhere in the region. So for those two reasons, from say 2015 through to 2020, we had limited exposure to China. Now, as you mentioned, there has been a growing exposure to China over the last kind of 18 months, 2 years, and that's really a function of three things. So the first one being a great understanding on our part of the investable universe, the types of companies that we get excited about, spending more time with them. The second point being valuations. I think since the end of 2020, you've probably seen private enterprises in China lose $4 trillion worth of market cap. And finally, a shift in the positioning of privately held or privately owned businesses in China. I think in February this year, you saw Xi Jinping sit down and shake hands with the large Chinese entrepreneurs, and I think that was probably a big turning point in how Xi and the CCP see the role of private enterprise. I know that's an important, I think, indication for us in terms of how we think about risk and opportunity in China.
So over the past 2 years, what's the exposure to China gone from, and what is it to today?
So it's gone from less than 10%. To I think 16 or 17% today, and I don't know what that is in the index, but certainly it's been for us as truly bottom-up investors. We're always looking for opportunities in the region where there's clouds hanging over particular countries or sectors, and in China, the opportunity over the last couple of years where you've really seen where you saw companies get sold off. No matter whether they were state-owned or privately held, what the company did, the balance sheet, the valuations, all these companies were sold off together. And for, bottom-up and stock pickers like us, that was the perfect market or perfect opportunity to really get on the road and see what's out there.
And you mentioned earlier, Stewart Investors, it has a capital preservation focus.
Yep.
Could you go into more detail about how, as a house, Stewart Investors invests and how it differs from other fund firms?
Yeah. So I think I try to move away from this idea that we are, defensive or too risk averse. I think, there's many ways up the investing mountain. And for us, we are really trying to position ourselves as the most attractive, long-term stewards of capital in Asia. we're kind of working backwards from that. And that really means looking for that combination of capital preservation and growth. And, the knowledge that if we want to compound clients' capital over the next 10, 20 years, we've got to be around to do it. So yeah, that capital preservation point is important to us. And I think if you look back over the performance over the last 15 years of the trust, we have tended to underperform fast rising markets where you've probably got a little bit more speculation, a little bit more greed, probably a little bit more concentrated performance in regards to the index. And then on the other side of that, the last 15 years, we have tended to preserve capital better than the index in times of stress. Now that is a function of a few things. So, coming back to how we think about risk, risk for us is the risk of losing clients' capital rather than deviation from a benchmark. And that has been, a fundamental input to how Stewart Investors has invested capital over the last 30 years. And then that leads to a number of other inputs. So we try to take a long-term perspective to allocating clients' capital. We're not trying to beat our peers in guessing what's going to happen next quarter. We're looking for, companies that we can allocate for as long as possible and really benefiting from the growth of great companies. When we're constructing the portfolio, we're trying to be as humble as possible. We, again, looking back over the last 15 years, we've never forecast any macroeconomic event. So we understand we can't do that. So we are looking to build a portfolio robust and resilient to most macroeconomic events. And I think actually, this is probably something that doesn't get enough attention in the investment industry, is just who are the people you're handing your money to. I think we're in an industry where everybody wants a numerical number with probably a couple of decimal places. But for us, we spend a lot of time asking ourselves who we're handing Pacific Assets Trust capital to. And that really leads to, I think, over 90% of the positions in the trust at the moment have a family, a foundation, or a founder behind them. So that has been an important input to the preservation and growth aspect, because when you go into that inevitable down cycle, you want businesses with robust balance sheets, resilient cash flows, the ability to think and act differently and look to maximize the value of a business over 10 years rather than 10 months. And owners think like that. But again, if you're in an industry like ours where there's lots of focus on quantification, there's lots of focus on short-term time horizons, people don't matter. We can read investment or reports written by investment banks that go run 100 pages and there's maybe one paragraph on the people. So I think one thing that certainly we are given in terms of our long-term approach, our active approach, is that ability to think differently about who we're handing money to. And you can see that hopefully in that when you are investing, in Pacific Assets, that you have your money alongside individuals and families that have, billions of dollars invested alongside you, and also generations worth of reputation at risk. And I think, that's a very, important thing to think about, I think, with Pacific Assets.
And your process, it involves seeking out predictable businesses that are also sustainable in terms of how they operate. So with China, has the investable universe increased over the past couple of years? Are you now seeing more companies come on your investment radar?
We are looking for companies, and I think that this is important in most markets, but especially in China, is companies where the management team are focused on quality of growth rather than quantity. We speak to a lot of Chinese companies, and the ambition is to be the biggest, not the best. And that really, I think, leads to many sectors in China, with very limited pricing power, limited margins, limited returns. So when we're talking to management teams, we're looking for companies and management teams that are focused on value proposition. And I think this has been a very interesting time to be talking to Chinese companies, because you can see what matters and the lessons that are being applied from the current economic downturn. That we've had some really interesting conversations with our companies about lessons they've learned going into this down cycle, what they're doing with their balance sheets, and how, importantly, how they're benchmarking themselves against global peers. I think there's some really great opportunities in China in the software space, in industrials, especially those industrial companies that are providing a service where price is not number one on the customer's priority list. So that example would be an industrial company that's saving time for customers. So we want a company that provides industrial automation inputs, and part of their value proposition is getting those products to clients as soon as possible, so they don't need to hold that on their balance sheet. And that serves two benefits to the customer: they save money, but also they have more time to spend on their core value proposition. So for us, there's a very long opportunity for these kind of industrial companies to evolve in China. And we also really like companies that get stronger at the bottom of a cycle. And, we're seeing that a lot in the industrial companies. So again, getting out there and talking to companies is some of the best ways that we can find opportunities. I think screening companies, it'll tell you what's gone well in the past or what's not gone well. But really it's change, I think, and also meeting the people that will create those long-term opportunities.
And you're what is known as a bottom-up stock picker. How does the wider macroeconomic backdrop influence your investment decision-making, particularly when it comes to deciding to increase exposure to a region such as China?
Yep, that's a good question. And we appreciate that our companies don't operate in a vacuum, so it would be naive to completely ignore what's going on in the macro picture. But I think probably China is a wonderful case in point in regards to the challenges and risks to your capital if you take a purely top-down view. I mean, over the last 30 years, the GDP has grown many, multiple times. There's been wonderful educational and health outcomes over the last 30 years, but I think the Chinese market's the same price as it was 30 years ago. So yeah, that's, I think, a great example of why, top-down you can sound very smart, but I don't think it's the right perspective to take when stewarding other people's capital. So for us, we are really trying to understand the opportunity, especially in China, for high quality companies to create value, not only for customers, but for their shareholders. And, that throws up a number of questions in regard to China. So we really struggle to find companies where there is a large presence by state-owned players. The playing field is not flat, and it really runs against the idea or our desire for great companies to inevitably dominate a market and lead through a better value proposition for their customers. If you're competing in it against the states, it's not a nice place to be. The second point would really be that you're coming back again to that. What are the dynamics that allow a company to win? There's many sectors in China where price is the dominant factor, and you have many companies operating in that space that have no consideration for profits. It's not a nice place to be. Probably the greatest change, and probably, we were in Hong Kong recently talking to a number of consumer companies, but post-COVID, you've really seen a major shift in the psychology of Chinese consumers. So not only have you had a major economic downturn with the tightening of wallets, but you have had the emergence of Chinese companies that can produce quality comparable to multinational players at a similar price. So for a long time, there was a perspective that multinationals could sell a trusted brand and they could just replicate models that have been successful elsewhere. And I think that that has changed materially, and certainly a dangerous place to be if you've got very high margins and consumers have changed their purchasing decisions.
And how much of a factor is political risk in your investment thinking when you're deciding whether to invest in a company in a particular region, such as China?
Yep. So, the political risk is a major concern for us. And again, coming back to that point on us being truly active. So if we can't get comfortable with a particular company, sector, or country, we will have 0% of the portfolio invested there, which is, the freedom that you don't have if you are constrained by the benchmark. So, political risk is a major concern for us, and especially that alignment question. I think for a long time, we've really looked to find great opportunities in the healthcare space in China. They have some healthcare burdens, whether it be diabetes or cancer, that's in line with what you see in the US from an absolute numbers perspective, but spend a fraction of their GDP on healthcare. So they need to develop a low cost, high quality healthcare system. What we've really struggled is finding that alignment with the states, because what we've seen is when penetration for a particular product reaches in line with the global West, pricing changes overnight. So you saw that with orthopedic products. You get an email one day saying the regulators decided to cut prices by 70% and share prices go with them. So for us, it's very much understanding how our companies are aligned with where the CCP wants to take China, and then also questioning, and this is a heavily, I suppose, qualitative question, is an allowable return. Certainly, we get nervous looking at companies that are extremely profitable in China because likely they will fall under, the lens of the state, which I think that qualitative kind of holistic view of risk is important in China. I think if you were a quality manager purely focused on defining quality and in quantitative terms, you probably have missed those risks in the past. So for us, keeping a close eye on that alignment with our companies. And again, if we were to see a shift in the CCP's positioning in regard to the importance of privately owned companies in China, and a shift back towards the dominance of the state, you shouldn't be surprised if you see the Pacific assets have a lot lower weight within China.
And would US tariffs also come into your investment thinking, particularly if it's a company that you're examining or own that is being hit by paying higher tariffs to the US?
Yep, as I said, we're trying to work backwards from all the ways that we can lose clients' capital, and certainly tariffs and a changing of the competitive environment is something that we get increasingly nervous about. I think what's important is come back and ask ourselves how much of the particular franchise and the investment cases is at risk here. And I think, a lot of the headlines probably overemphasize the dependence of many Chinese companies on the US. I think post-Trump 1.0, lots of companies realized that they needed to diversify revenue streams. And you've seen a lot of Chinese companies, especially in regards to overseas growth, emphasize, Latin America, Africa, ASEAN, rather than just selling into the US. So I think the underlying risks to cash flows for many Chinese companies are probably not as high as people assume. And then, we have material positions in the trust in India, and we have a number of industrial companies that are globally aspirational in their targets over the next 10, 20 years. And I think for us, when we are looking at industrial companies in India, we're looking for companies that are not competing purely on price. Coming back to that point on what you're competing on. We're looking for companies that are offering high quality. They're looking to build trust with customer bases over time, and they increasingly understand, especially when we talk to these companies, that you can't build a world-class company in India if you're just leaning into kind of labor arbitrage and competing on price.
Let's move on to India. So as you mentioned earlier, 15 years ago, it was a relatively small weighting in the investment trust. It's now your top country weighting, although you've been taking some exposure off. Is that all down to valuations, or are there other factors at play? And for a couple of years now, India has had a premium valuation compared to other regions. Is that justified?
So as you said, yes, so for the last 10 years, India has been the material exposure of the trust. I think what's important to highlight about the investable universe in India is the breadth of the opportunity set. We have the ability to own a number of world-class companies with wonderful long-term opportunities, with exposure to a number of really exciting trends. It's not like some perhaps Asian or emerging market out there where you're forced to either own a bank or a telecom company. So if you were to look at the underlying exposure that we've had in India, it has evolved materially over the last 10 years, despite that weight being consistent. So we have, the material shift is seeing a reduction in our exposure to consumer staples, which for those of you who know Stewart investors well, consumer staples have historically been a wonderful place to provide the outcomes that we're looking for in terms of resilience at the bottom of a cycle and nice long-term growth opportunities. But today we're being asked to pay very, very high multiples for growth that isn't as certain as it was in the past, and that's due to rising competition and evolving distribution channels. We've reduced consumer staples, and then coming back to that point on industrials in India, that's certainly something where you're seeing an emerging set of aspirational companies with very ambitious long-term owners at the helm. And I get really excited anyway about when you hear them talking about taking on global industrials in their backyard. And when you look at some of them in the European industrial companies that are now very large, very bureaucratic, kind of do a bit of everything, these are the types of companies that our Indian owners are very excited about taking on. Yeah, that's certainly been one evolution I'd highlight over in regards to what's been going on in India. In regards to valuation, we own companies, not countries. And I think, coming back to comparing China and India, which is inevitable, I think, in Asia, is the divergence in the largest companies in both indexes, the divergence in the ownership structures. And then on that, just highlighting that, the companies we own look and behave very differently to the index. So I think of the 100 largest companies in India, we throw 75% of them out for governance, franchise, or sustainability, positioning question marks. So we're not owning the index. What we would say is that when it comes to valuations, we try to take a step back from looking purely at short-term price to earnings ratios and kind of lean into the advantage that we have of taking a 10-year time horizon and asking different questions and asking, what is this company worth to us over the next 10 years rather than, it's at 10%, price to earnings premium. And I think that's something that we try to utilize as much as possible and not get sucked into the short-term game of just, comparing price to earnings ratios.
You mentioned that you invest in companies, not countries. However, when looking at the portfolio outside of both India and China, which countries do you have the most exposure to and why?
So we've got material weights in Taiwan, which again is the result of finding truly world-class industrial companies, largely run by long-term competent stewards. Probably, one country I think that's worth touching on is the Philippines, in that it's now, I think, 7% of the trust. You've seen the trust increase exposure to the Philippines for a couple of reasons. Firstly, valuations are very enticing, and coming back to that point on finding parts of the market where there's clouds hanging over them. The Philippines is kind of the land that the foreign investors, forgotten. We were there a couple of months ago, and the brokers that took us around, it was like them seeing aliens. They were so surprised to see a foreign investor rock up. So I think that's certainly something you don't see at the top of a market. And then from a company perspective, there are a number of very well governed companies in the Philippines.
As you've explained, you invest very differently from the index. You have a capital preservation focus, and I know that you have a long-term investment approach. But if you look at shorter periods, say over the past 1 year, the trust has made a small loss in both net asset value and share price total returns. Could you explain why that's been the case?
Yep. The performance has not been helped by the lack of exposure in the trust to Chinese mega caps, Chinese banks, and the very strong performance of TSMC. And then also on the other side, within the portfolio, the larger Indian holdings that we have, they've seen relatively muted performance over the last 12 months. So certainly that combination has not been pretty for relative performance over the last 12 months. But I think, for us, as you said, we're focused on creating, long-term value for underlying shareholders. And that really means focusing on, 10 years, 7 years. That's where that focus on capital preservation and the focus on people really contributes to compounding. Over any 12-month period, it's largely multiples and noise that drive earnings, or share prices, sorry. And I think any philosophy has to have a trade-off and a cost. And for us, the cost is not being drawn into attempting to outperform every 12-month period, and the cost is explaining why we have underperformed. And I hope that when clients look at the relative performance of the last 12 months, they can understand that underperformance. And if we were to have outperformed over that period, I think it would have required material shift in the investment philosophy. So it would require less of a focus on governance, less of a focus on leverage, and a shift to how we see position sizes. So TSMC is it's a wonderful company. We've owned it, I think, since 2010, 2011 when we took over the trust. It's currently a 2% position in the trust, and it's a 10, I think it's 10 or at least very close to 10% in the index. We wouldn't have 10% in our highest conviction name partly coming back to that view of risk and humility, and not wanting the portfolio to be overly exposed to a particular name or sector. So yeah, I mean, TSMC is a wonderful name and a wonderful company. But that position size for us is really a reflection of how we see risk and valuations. And
looking ahead, what would you say is the main reason for optimism and also the biggest risk for investing in the Asia-Pacific region?
I think the biggest risk is with Asia, given the diversity of the markets, the number of very large democracies, the number of nuclear-armed borders in the region. I think there's always something to worry about. There's always going to be a headline or two that's picked up and has the risk of forcing you out of your Asian exposure. Asia really does offer some wonderful long-term structural opportunities, whether that be financial inclusion, the rise of billions of middle class, the rise of manufacturing powerhouses in say Vietnam or India, and then coming back to that point on what it is that Pacific Assets offers underlying clients. It's that those long-term opportunities have always been there, but what does Pacific Assets offer? It offers you to align your capital with owners that are willing, I think, and able to benefit from those trends. They've got their money invested alongside you, and like I said, I think they're trying to build a better business in the next 10 years rather than the next 10 months. Valuations are very attractive in our view for that growth opportunity. Some of the portfolio metrics for the trust, I think if you were to look at free cash flow yield, it's near all-time highs, and you combine that with the number of opportunities that we're coming across in the region, and it tends to indicate a pretty attractive opportunity longer term. And I know that obviously the US has done very well. I think when we talk to some of our clients, they've got the lowest exposure to Asia that they've ever had. I think diversification is important, and getting exposure to Asia over the next 10, 20 years through a trust that is allocating to outperform over those periods, and not being dissuaded from that due to political headlines or the outperformance of the US. I think the probably greatest risk is not having exposure to the region over the next 10 years.
Well, thanks to Doug, and thank you for listening to this episode of On the Money. If you enjoyed it, please follow the show in your podcast app and do tell a friend about it. And if you get a chance, leave us a review or a rating in your podcast app too. We love to hear from you. You can get in touch by emailing otm@ii.co.uk. And in the meantime, you can find more information and practical pointers on how to get the most out of your investments on the Interactive Investor website, ii.co.uk. And I'll see you next week.